Hello and welcome to Keep Calm and Carry On in Retirement with Liz Coe. My name's Ralph Stewart. I'm the founder and managing director of Lifetime Retirement Income. Over the next sort of 20 or 30 minutes, we're just going to talk through some of the issues as they relate to the investment environment today. Try and share some experience with you that I hope will give you some comfort to know that even though things look pretty tough out there, they're not really. There are good answers, there's some good history to share, and particularly if you're having an income in retirement, it's all taken care of. Let me start by introducing Liz to my right and your left. Known Liz for a long time. Liz is an accountant. She's an economist. She's an author. She's very well known in New Zealand for matters financial, and very lucky to have Liz today. Liz, nice to see you.
Thanks, Ralph.
We need to do some of the disclosure type work. So Liz, can I ask you just to confirm your disclosure statement?
Well, actually, I am no longer a financial advisor, a registered advisor. So I am what I call a money expert, but I just wish to reiterate that whatever I talk about today should not be considered to be personalised advice. And I really recommend that you go and speak to someone, professionally, if you're not sure about how what we talk about today applies to you. So it's always a good idea, to get some professional assistance. But yeah, I no longer have a disclosure statement available as such, but that is my disclosure. That is, please don't treat this as personal advice.
Great. But we get the benefit of all your experience.
Yes.
Terrific.
Yeah.
I also need to say that Lifetime Retirement Income Fund, Lifetime Asset Management, which is owned by the Lifetime Retirement Income Group, is the manager of that fund. Okay, where's a good place to start? What about the big picture? All the noise on the TV, all the media, concerns around house prices, concerns around the war, concerns around inflation, concerns around asset prices. How can we get all the negative out of that?
Well, it seems to be all doom and gloom at the moment, doesn't it? And a lot of people have sort of taken a big deep breath in and are sort of, there's a bit of sort of stunned mullet type syndrome happening out there. What do we do in this environment? Because as you say, there's a lot happening. We've got and high inflation, over 7%, which for people in retirement, that's a big issue, because I don't think, there's always a lag, with NZ Super going up. It doesn't seem to keep up quite with inflation. We've got property values going down. We've got interest rates going up, which I guess is good news for investors, but they're not going up by anywhere near enough to cover that increase in inflation. Then, of course, we've got the market volatility caused by a whole variety of things, including all the, the political problems around the world. So this is causing people to have a lot of uncertainty, and people are sort of saying, well, what should I do in response to this? And I guess for some people, they're thinking, well, perhaps I should just do nothing and wait it out. But I think, as per the title of the session, this is very much a case of just, keep calm and carry on. We've seen a lot of this before. What we're experiencing now is a change in market cycles, and we've had, I've been in the advice business for well over 20 years, and Ralph, you've probably been in this industry a lot longer than I have, and we've seen it all before, haven't we? We've been there, done that. Every few years, there's a crisis of some sort, or the market goes through a bit of a convolution and a change of pace, and as we look forward, this is going to happen again, isn't it? In people's lifetimes, when you're facing 20 to 30 years in retirement, over that time there's going to be a number of occasions where we have circumstances like this, and yes, every crisis, if you like, is slightly different in terms of what causes it and how it plays out. But we know with certainty that that's how markets behave over the long term, don't we?
Completely, Liz.
You've seen it all before, haven't you?
So, like you, the explanation of risk can come in volumes and volumes and volumes. But in an investment sense, the reason there's a difference between the return on a share, for example, and a term deposit is risk. Yes. There's a difference between the two. Investors are on two sides of the ledger. One is the person receiving the money. The other side of the ledger is the person spending the money. And both people have different views on the value of money. So, for example, why is one company better than another? It's perception and view.
That's right.
And it's that element of price and risk that creates the volatility itself. And without that, there wouldn't be the additional return.
Exactly. So, I've always said to people, volatility is good. It's not something to be scared of, because without volatility, you would have, a market that was dead flat, and therefore you get no return. And, we are all about return. And that means, downside as well as upside. You take the bad with the good. And on average, over the long term, you do okay. You do more than okay. So without volatility, we aren't going to get as good a return. And it's a question of how you manage that volatility. But I think, when the market goes down, is not a time to stop doing what you've always done. Because we know, when we go about investing, we know that there's going to be occasions when that happens. And it's just, part of normality, isn't it, really? It's not an abnormal situation, that volatility in the market downturn. It's part of what you consider to be normal market behaviour over the long term.
Exactly, and that's why we try and understand investors' attitudes towards risk. Because for some people, high volatility is just too much, and they worry too much.
Yeah.
Other people, they're more comfortable with the notion of volatility contributing to returns. So kind of finding that medium that's right for an individual is fundamental. It also changes a bit in the income space when you're drawing down a retirement income, because we're obviously looking at a very long term. At Lifetime, for example, most of our customers are just beyond about 65, 66, heading to 70, and they'll be with us till they're 80 or 90. So when we talk about inflation, over that 20 or 30 year period, you can absolutely normally expect inflation to be near zero and to be near 8%. During that time, it'll go to both of those places at least once or twice. So this current issue of 7% is real. It impacts people's ability to buy things and the cost of goods and services today. But over a retirement of 20 or 30 years, it's really only just a very, very small part of the journey.
That's right, yeah. So perhaps we could talk a little bit about retirement income, do you think? Would that be a good subject?
I would love to.
Seeing that's something that you specialise in. And, I think there's a lot of confusion out there in terms of what is retirement income. Would you agree with that? Definitely, Liz. Yeah.
We've got a long way to help people understand that it's about using your capital wisely, getting a good return on it, but using both to provide comfort, security, and retirement, not just relying on return on capital alone.
That's right, because if you try and rely just on investment return to provide an income, then you're probably going to end up living in poverty for much of your retirement. So I think, in retirement, we're really interested in having money available when we need it. And, from the point of view of a retiree, you shouldn't need to be worried about where that money comes from, whether it's from investment return or whether it's from capital. And we're not about preserving capital in retirement. We're about running it down slowly over our lifetime. And, I often talk about what I call, the Goldilocks factor, which is, running down your money at just the right rate. So it's not too quick and it's not too slow. So if you run it down too quickly, you're going to run out before you run out of life. And if you run it down too slowly, then you're going to miss out on spending money that you could have otherwise spent, and which, and then of course, your children or whoever else your beneficiaries are will get the benefit of that. So it's finding that sweet spot. It's running down your money at a rate that's neither too fast nor too slow. It's that's what I call the Goldilocks rate.
Yes.
And it's about just managing that process. But it's not that easy to do on your own in an unguided fashion. But I think we do need to be prepared at times like this where markets are heading down. We need to be prepared to dig into our capital and to know that it's actually okay to keep on spending, even in that environment, because we are looking at the long term. And so we know that there will be periods during our investment time frame where we do have to dig into our capital when the market's on a downward spiral. But then we know that there's upswings as well, and that will make up for those periods. So on average, over our lifetime, we should be doing okay. And I think, there is a real danger that people will end up underspending because, as soon as there's a market downturn, they think, oh, I'm not making a return on my investments, I have to stop spending. But it's not like that, is it?
It's not like that at all. And Liz, it's so much passion for your comments because we're called lifetime because in the calculation of retirement income, it's about your life and it's about time.
That's right.
So often we enter a conversation about retirement income, which begins with what investment returns can you produce? And it always begins there when it really should begin with the individual.
Yes.
Their life expectancy, the amount of money they have, and what sort of life they want to have in retirement.
That's right.
Just to give you a simple example of what we do, we understand from investors in retirement what the nature of their income needs are, not the nature of their investments per se, that's full financial advice. We just need to know what their income requirements are, what capital they have, their age, whether they're a couple or an individual, and then we calculate a level of income they can earn every fortnight after tax and fees that will last their lifetime. Then we monitor that calculation to ensure that if there are any shocks like they are now, they're compensated for in the equation to ensure that income level is the right one, and it will indeed be that right one for the next 20 or 30 years.
So that's that Goldilocks rate.
It's the Goldilocks rate. Correct. Spot on. We're going to rename it.
There we go. Because it's something that people do need a hand with, isn't it? It's really hard when you're, just beavering away on your own to know whether you're withdrawing, you're taking out too much or not enough. And there's no easy answer. And even the best experts in the world grapple with this issue, don't they?
Exactly.
How do you decumulate wealth? And there's various things like rules of thumb that you'll read about.
Exactly.
But I think at the end of the day, it's very much a personalised thing. The rate at which you withdraw from your portfolio depends on your own personal circumstances, your own longevity predictions, what you want to do with your life, what kind of lifestyle you want. And so it's really hard to just apply a standard rule of thumb.
Exactly.
So I think there is a huge gap in the market, as I see it, for advice in this space, and to make it easy for people, because when you're retired, you don't want to be worrying about money and trying to perform complex calculations to see if your portfolio can withstand X amount of withdrawals. That's not what you want to be doing. You want to be out on the golf course or
Exactly.
cruising down a river somewhere in Europe or whatever. You want to be doing those kind of fun things rather than sitting there with your calculator trying to work out what you can and can't afford to do. So I think what lifetime income is aiming to do is absolutely spot on, to provide that easy solution for people so that they know they've got that regular top up and that it's at an achievable, sustainable rate, for their goals over the rest of their lives. And I think, that's, it's a pretty unique service in that regard, isn't it? I struggle to think of anybody else who provides that type of product and service. So
It's our passion.
Yeah.
It's just what we're all about, a worry-free retirement.
Yeah.
That's what we're trying to do. If you ask, what are the big challenges in your calculations and providing an accurate and reliable income every fortnight? They sort of fall into two spaces. One is, sensible investment returns and a good investment return strategy. We invest in over 2,000 different companies around the world, all those sorts of things. And we expect to return about 5.5% per year over about 25 years. And of the difficult things to do, that's the most least difficult. We can do that successfully, as can others. The harder piece is time and age and mortality. It's more of this classic phrase, it's an art, not a science.
It is, yeah.
Mortality is looking backwards. It's sort of the nature of how people have passed away in the past. and then projecting that forward.
That's right, but it's changing all the time.
Exactly, it's constantly moving.
Mm.
And the reason we have to monitor the incomes, of all our customers is their aging patterns are so different. We know that a 70-year-old who finally gets to 80, the probability of living to 90, just by virtue of the fact they reached 80, has changed.
Mm.
So we're constantly moving the slide roll back and forward to recognise the aging process, which is, well, in my view, more fundamental than investing.
Oh gosh, if only we knew how long we had.
Exactly.
But then didn't really want to know that. So, yeah.
I agree.
Yeah.
Again, trying to sort of simplify the process, investment returns, as you said, Liz, are subject to volatility over short periods of time, but over long periods of time, they do flatten out, and we can be confident about a 5.5 before tax expected return. Inflation, for example, we're using 2% now, when if you read the paper this morning or tonight, you'll see it's probably around 7. The reason it's that, it's 7 for probably the next year and a half, but over 20 or 30 years, it looks more like 2.
Mm.
So we're constantly reshaping those things. But moreover, as you said, Liz, there's the aging process, which is a bit of an average. Everyone, even underneath the aging process, is very different. We have customers, for example, who ask us to calculate their income because they have health issues, and the real average mortality just doesn't apply to them.
Mm.
So it's a very personalised Goldilocks rate.
Yeah.
We have other people who have requirements to have capital when they might pass away for their families or for other things. So we calculate to leave a residual.
Mm.
So there's the issue of the average mortality, but there's also the issue of trying to give people a personalised mortality.
Yes,
that recognises their life.
Absolutely. Yeah.
Some of the common things that have come up recently have been, as you said, Liz, fear and concern because of the media, worries about inflation and their account balances.
Mm.
So you're paying me a regular amount of income every fortnight. I can see my account balance has gone down because markets are down, value of assets are down. And would really like just to remind everyone who's a customer of Lifetime watching this that we're constantly monitoring that for you. We have what we call safety margins to make sure that as markets move up and down, your income stays flat. And yes, we might have to suggest you change your income levels, but that's unlikely to be more than once every 5 years. And even in the current volatility, there's no need to change it now.
Mm. And I think, the important thing is that we are really in transition between, one state of the economy versus what we're moving to a different state. And this isn't going to go on forever, is
Exactly.
it? And, this time next year will be a whole different scenario. Because as we know in economics, nothing ever stays the same. And we know, the cycles move on through and, downturns followed by an upturn. That's just, it's like night follows day. It's like high tide follows low tide.
Completely.
It's just a natural cycle. And so this is really a temporary situation. And we've just got to keep, going on through it. It's normal, even though it feels a little bit abnormal, because I think, if we look back over the last few years, we've had a pretty good run, haven't we? Apart from that bit of a blip when we first had COVID announced and the market took a bit of a dive, if you take that out of the equation, it's been a very strong run in investment markets. And I think we've just got a little bit out of practice in terms of knowing how cycles work.
I agree.
And being comfortable with those changes. So I guess, the message is, there's nothing abnormal happening out there. It's a short-term transition. Things will come right. And, we should just keep calm and carry on.
Completely. I'm not sure. The notion of volatility, I think you mentioned before about our combined time in the market. If we add those together,
that's a lot of years.
Embarrassing number. I go back to the Dunedin Stock Exchange. Do you remember that?
Oh, wow.
There used to be regional stock exchanges in New Zealand.
That's right.
There's one in Auckland, one in Dunedin. My father ran the stock exchange all those years ago, and he was one of the responsibilities for centralising the stock exchange away from Dunedin. I remember those days as just a little fella seeing the chalkies in action.
Yes. Oh,
so
gosh.
The price of a share was written up in chalk on a chalkboard, and depending upon the buy and sell volume, which was also written up, it was rubbed out and replaced. And that was the stock market trading.
And I can remember at lunchtimes in Wellington,
Totally.
people would crowd into the rooms to see what was happening in the market.
Exactly.
It was just, yeah.
And the passage of information was just so narrow. As you said, you went from the lunchtime review to the stockbroker on the phone, reading out to the office what was on the whiteboard was being constantly changed. So that whole passage of information, by the time anyone got to act on it, could be days.
Yes,
in practice. Right. Today, they measure it in 1/100th of a second. So you can see the element of volatility that's crept in just by having information made so readily available. People make decisions so much faster. So I'd argue some of the volatility we see is genuine market volatility because people have different views on the value of assets, which is just how it works. We need that. But the other element is just the expedience of technology and time.
That's right.
That enables people to use volatility far more quickly than they ever could in the past.
Yeah, no, it's a very different market than it used to be when we first set out in this industry.
Want to know a wee story?
Sure.
When the Wellington Stock Exchange was finally closed, I was there with my father, and I still have a box at home. And if anyone would like one, I'd be happy to show them or share them. I still have some of the tickets off the board.
Oh, wow.
Do you remember Ariadne?
Oh, yes.
I have that. I have a Briley's ticket.
Wow.
We should auction those.
We should indeed.
Showing our age now. Anything further? Are you okay?
No, I think we've covered all the bases there, Ralph. Yeah. So, yeah.
Listen, thank you very much for watching and listening to us today. We hope that's helpful. I hope you can get a sense from Liz's comments and mine that, really don't panic, don't worry. At Lifetime Retirement Income, it's about you not worrying. That is our goal and our ambition. We are structured to ensure that's the case. So please don't give yourself worry when you don't need it. You're in good hands and good shape. If you ever do need to review your income amount or just want to see what's going on with the calculator, please visit us, lifetimeincome.co.nz. Use the calculator anytime if your needs change or your lifestyle changes or you just want to have another reassessment of your own position. So all it leaves me to do is to thank Mighty Liz again for helping us and sharing her experience with us. Thank you, Liz.
Thanks, Ralph.